Here is the figure nobody included in the graph: $200 per month. Below that level, compound interest does not cease functioning. It functions so gradually that your account balance is practically indistinguishable from a standard savings account for the initial decade. And the majority of financial calculators are deliberately engineered to render that invisible. And there is a second figure. The graphs never reveal the precise moment in time when your returns begin surpassing your contributions. That is referred to as the phase transition. There is a calculable month. It occurs for every investor. And right now, I am going to demonstrate exactly how to identify yours. Nobody breaks down compound interest in this manner. You have seen the graphs, the ones that begin modestly and arc dramatically upward into millions of dollars across a few decades. You performed the identical math on your own circumstances. Maybe you even opened an account. And then you reviewed the balance a few years later and wondered, is this it? That sensation has a name. It is phase one. And comprehending it might be the most financially valuable 20 minutes you invest this year. Let me attach actual figures to the problem first, because vagueness is worthless. The S&P 500 has averaged roughly 10% annually across the last century, after adjusting for inflation closer to 7%. Every single calculation in this video uses 8% conservative, realistic, not a best-case projection invented to make a graph appear impressive. At $50 per month, 8% annual return after one complete year of consistent investing, you have earned approximately $5 in returns. $5. After 10 years of never skipping a single contribution, your account contains roughly $9,200. Of that, almost $6,000 is money you personally deposited. Less than $3,200 originated from compounding across an entire decade. After 30 years of perfect, unbroken discipline. 74 divided by 500, 30 years. 30,000, zero missed contributions. 74,500. The Bureau of Labor Statistics reported that average annual household expenditures in the United States ran approximately $40,000 in 2025. Your 30 years of iron discipline cannot cover 2 years of average living costs. That is not a failure of character or effort. That is a threshold problem. And today I am going to demonstrate exactly where that threshold exists, what it costs to reach it, and why the instinct most people have when they notice the problem makes everything significantly worse. Here's what I'm going to address. There are two completely distinct phases of wealth building, and virtually every piece of financial guidance you have ever encountered treats them as a single continuous process, uses the same language for both, applies the same logic to both. They are not the same thing. They have different rules, different priorities, and a completely different relationship with your return rate. Once you perceive them as separate, the frustrating parts of your investment journey start making sense, and the decisions that genuinely matter become obvious. By the way, I constructed a free early retirement calculator because most online ones are mathematically flawed. It uses BlackRock and Vanguard logic to expose the vulnerable points in your plan. And I only request your email to deliver the report, so I do not store any of your financial data link in the description. Now, I want you to conceptualize compound interest the way a mechanic conceptualizes a turbocharger. A turbocharger uses an engine's exhaust gases waste energy, the byproduct of combustion, to rotate a turbine that compresses incoming air and forces it back into the cylinders for another pass at power generation. The waste product becomes fuel. Output becomes input. The system amplifies itself. You recognize this structure of the feedback loop where growth generates more growth. That is another name for compound interest. But here's the thing about turbos that most car owners have never been informed. They do not function at low RPM. Below a certain engine speed, there is not enough exhaust pressure to rotate the turbine. The turbo is physically present, bolted to the engine block, real part of the system, but it is not doing anything you can detect. The engine runs entirely on direct combustion. Every bit of power comes from exactly what you put in, nothing more. Then, at a specific RPM threshold, the boost engages. Drivers call this being in boost. The power delivery changes completely. The engine produces significantly more than the fuel input alone should justify. The feedback loop has activated. Your investment portfolio does this exact thing. Before your balance reaches a certain size, you are the engine. Your monthly contributions are the combustion. Your returns are the exhaust technically cycling back, technically compounding, but not at enough pressure to rotate anything meaningful in your real financial life. The turbo is there, it is running, but before the turbo kicks in, you are providing all the power yourself, manually every single month. The threshold where the boost engages, where compounding starts doing more work than your contributions, tends to fall somewhere between $100,000 and $150,000 in total invested assets. I will show you the math behind that figure shortly. Every dollar you contribute in phase one is getting the engine up to the RPM where the boost kicks in. That is the entire game in phase one. Everything you do to accelerate that process, earning more, cutting unnecessary spending, redirecting raises, any extra income serves exactly one goal: getting the pile large enough for the percentage to matter. Before the turbo kicks in, contributions are the strategy. Compounding is the reward you collect after. In a few minutes, I am going to reveal the single most common mistake phase one investors make. The one that feels like the smart move and almost always makes things worse. But first, here is the actual math that the attractive charts keep concealing from you. All of these calculations use 8% annual return, monthly compounding, same time frames. The only variable is how much goes in per month. $50 per month. 10 years, $9,200. 20 years, $20,950. 30 years, $70,450. $200 per month. 10 years, $36,800. 20 years, $117,800. 30 years, $298,000. $400 per month. 10 years, $73,700. 20 years, $235,600. 30 years, $596,000. The interest rate constant, the time frame constant. The only variable was how much went in each month, and the 30-year result moved from $74,500 to $596,000. But that table conceals the figure that actually matters most. At $50 per month, your portfolio never crosses $100,000. Not in 20 years, not in 30. You spend your entire investing lifetime in phase one. The turbo never reaches the RPM to engage. You grind through 3 full decades and never arrive at boost. At $400 per month, you cross $100,000 around year 14. After that crossing, compounding starts visibly outpacing your contributions. The monthly split flips. Phase 2 has started, and you have 16 years of Phase 2 compounding before you hit the 30-year mark, which is where the terminal balance difference between $400 per month and $50 per month stops being a math problem and starts being the difference between a retirement and a part-time job into your 70s. Andrew Hall was a high school English teacher in British Columbia who retired with over $1 million on a teacher's salary. He wrote a book about it called The Millionaire Teacher. People who encounter that story almost always extract the frugality lesson. Drive old cars, pack your lunch, avoid lifestyle inflation. All of that is in the book, and all of it is true. But they missed the mechanism. The frugality was not the point. The frugality was how he funded a high enough monthly contribution to cross the threshold while he still had enough time left for Phase 2 compounding to do serious work. His final decade before retirement, by his own account, felt almost effortless. The math had taken over. He barely had to think about it. The engine was running on the turbo. Before the turbo kicks in, you are packing lunches. After it kicks in, the lunches do not matter anymore. The engine has its own momentum. Nobody posts the packing lunch years. Social media shows you year 18. You compare your month 40 and conclude your strategy is wrong. The strategy is not wrong. You are in a different part of the same journey. Now, here is what nobody is actually telling you about Phase 1. And this is the reversal that reframes everything. When most people hit the Phase 1 feeling the dull frustration of checking a balance after several years of consistent investing and seeing underwhelming figures, they make a diagnosis. The diagnosis is almost always my return rate is too low. So they start chasing. You think the problem is your return rate. The actual problem is your contribution level. Let me prove this with figures because this is the kind of argument that collapses without them. $200 per month at 8%. 10 years, $36,800. Now, let us say you somehow double your annual return from 8% to 16%. Consistently for 10 years. This is a figure that most institutional fund managers in the world do not hit on a sustained basis. PIMCO, Fidelity, the major quant funds, very few sustain 16% annualized over a decade, but let us assume you manage it. 10 years at 16%, $200 per month, approximately $52,200. That is $15,400 more than the 8% result. It sounds significant until you understand what achieving 16% actually costs in real behavioral terms. You are taking on volatility that drops your portfolio 40 to 50% in bad years. Dalbar, the financial analytics firm that has tracked actual investor behavior since the 1980s, reports in their annual quantitative analysis that the average equity fund investor underperforms the S&P 500 by 2 to 3% annually over long periods. The primary cause, panic selling at market lows and chasing recent performance. The 16% theoretical return produces something closer to 8 or 9% in real human hands, and gets there via several genuinely traumatic portfolio events that most people are not emotionally equipped for. I know a person who runs a small manufacturing business, sharp with operations, not particularly interested in markets, who was doing exactly this in 2018. He had been contributing $200 per month consistently for 6 years. Account had grown to almost $20,000. Then he heard about a biotech stock at a dinner party, redirected 4 months of contributions. By the summer of 2019, the position had lost 60% of its value. He did not lose his life savings, but those 4 months of contributions, $800, were not in his account compounding anymore. And the real cost is not the $800. It is the 30-plus years that $800 was supposed to compound at 8% over 30 years that $800 was worth roughly $8,500 at the end. Gone from one dinner party conversation. Now, instead of chasing returns, what if you increased your monthly contribution from $200 to $350? Same boring 8%. Same 10-year frame. Same index fund you already own. $350 per month for 10 years at 8%, approximately $64,000. More money? Less risk? No dinner party disaster? No panic decisions? No trading fees or tax events? The contribution increase beats return chasing every single time when your balance is small. Not as a general principle, as arithmetic. By the way, hit subscribe if you are getting value from this. Otherwise, the algorithm may genuinely never surface these videos to you again, and this kind of analysis drops every single week. The reason financial media almost never makes this argument clearly is structural. There is no product attached to increase your contribution to a boring index fund. And wait, a brokerage account you add money to and do not touch generates almost nothing in trading fees, advisory revenue, or fund management income. Complex strategies, active fund selection, premium access, timing decisions, those are monetizable. Boring contribution discipline is not. Your return rate is the interesting figure. It generates articles, comparison tools, thumbnails, debates. In phase 1, it barely matters. The lever that moves your outcome is not the market. It is what you deposit. Think about the dollar output of 8% at different balance levels. 8% of $10,000 is $800 a year. $67 per month, that does not change your financial picture. That is a tank of gas. 8% of $100,000 is $8,000 a year. $667 per month, that is real monthly income from doing nothing. 8% of $500,000 is $40,000 a year. $3,833 per month. That is retirement income. That is financial independence. Same percentage, completely different life. The only variable is the size of the pile. Phase 1 is pile building. The percentage is noise until the pile is large enough for the percentage to produce output you can feel. And this is where fees become genuinely dangerous. Not in the vague fees add up way that financial content always phrases it, but in specific, calculable dollar amounts that are worth understanding. A 1% annual advisory fee on a portfolio earning 8% before fees leaves you earning 7% after. Over 30 years of a $100,000 portfolio at 8% grows to approximately $1,006,000. At 7%, it grows to approximately $761,000. The fee cost you $245,000. Not the fee itself, the compounding of the fee's absence accumulated over 3 decades. The insidious part, the damage is invisible in phase 1, when your account is $16,000 and the fee is $160 a year. It registers as catastrophic only when you are in phase 2 and you do the backward math. By then, it has already happened. Your financial advisor carefully monitoring your well-diversified portfolio while you stress over whether to be in the 8.2% fund or the 8.7% fund. Perfect. Keep watching right there. Now stay with me because this is where the video moves from the math problem to the more expensive problem, the one that the spreadsheet cannot capture on its own. Phase 1 does not fail because the math stops working. It fails because the math works so slowly that most investors' brains misread the results as evidence that the strategy itself is broken. Richard Thaler, behavioral economist and Nobel laureate in 2017, described what he called the feedback gap problem in financial motivation. Humans continue behaviors when they produce visible results. They abandon behaviors that appear not to produce results. Compound interest in phase 1 generates returns so small, they fall below the perceptual threshold, the minimum output level the human brain registers as meaningful progress. Your brain reads not working. The accurate reading is working exactly as designed, at a scale too small to feel yet. That gap between mathematical reality and felt experience is where the most expensive financial decision gets made. Not panic selling, though panic selling is expensive. The most expensive phase, one mistake, is the strategy switch. You correctly identify that something needs to change. You incorrectly diagnose what it is. You move from an index fund into individual stocks, or you redirect several months of contributions into something speculative. Or you sign up for a stock-picking newsletter, and now you are not doing phase 1 investing anymore. You are trading entirely different activity, completely different set of historical odds. Terence O'Dean and Brad Barber at UC Berkeley published research in the Journal of Finance in 2000, tracking 66,000 individual brokerage accounts over a 6-year period in the 90s. Their finding, the most active traders earned annual returns of 11.4%, during a period when the market returned 17.9%. A 6.5% annual underperformance primarily driven by trading costs and the behavioral tendency to buy recent winners after they have already run. The least active accounts nearly match the market return exactly. Doing nothing in phase 1 is not passive failure, it is the statistically optimal decision. The problem is it does not look like a decision, it looks like waiting. And waiting feels like not doing anything about the problem. Nobody posts the phase 1 screenshots. Finance communities online are full of phase 2 portfolio balances with cheerful captions. You are comparing your month 38 to someone else's year 19 and concluding your strategy is defective. Your strategy is not defective. You are in a different part of the same journey. Staying disciplined through all of phase 1, by the way, is the highest performing strategy available to a small investor. I understand that is impossible to make into a thumbnail. Here is where I want to bring in a specific situation because the abstract becomes real when it has a name attached to it. Marcus is 38, works in logistics management, earns around $78,000 a year, a solid income by most American standards. 8 years ago, his company launched a 401k plan. His HR representative walked him through the enrollment. He picked a diversified target date index fund. He set up automatic contributions of $150 per month. He has never missed a single contribution. He has never panic sold. He checks his balance quarterly and reads some financial content on weekends. His current balance, $6,500. He has done the arithmetic. He has contributed approximately $14,400 over 8 years. Returns have added about $2,100. $2,100 from 8 years of consistent, disciplined investing. He is starting to wonder if the whole thing is designed for people who already have money, people with large enough accounts that the percentages produce output that actually matters. He has been looking at a friend's real estate deals. He heard about a fintech stock that doubled last year. Marcus is not making a math error, and he is not doing anything wrong. His engine is running exactly as designed, but at $150 per month, he has been well below the boost threshold the entire time, and he will remain there for decades at this trajectory. The answer for Marcus is not a different vehicle. It is more fuel in the same engine. Here's what the figures actually show for Marcus. Starting today at 38 with 27 years until 65, scenario 1, Marcus keeps contributing $150 per month. At 65, his balance sits at approximately $121,000. He cannot retire on that. He will be supplementing Social Security well into his early 70s and hoping his health cooperates. Scenario 2. Marcus increases to $400 per month, $250 or more per month, less than half the average American car payment, according to Experian 2025 data. Roughly 3.8% of his gross monthly income. At 65, approximately $337,000, 3 times the result from less than 3 times the contribution increase. Because crossing the threshold earlier gives Phase 2 compounding more years to run at full power. Scenario 3, Marcus gets to $600 per month, achievable with 1 evening of rideshare driving per week in most metro areas at current platform average earnings. At 65, approximately $537,000 combined with Social Security and reasonable sequence of returns management in his final years. That is a genuine retirement on his own timeline. The difference between $121,000 and $537,000 is not intelligence. It is not a secret investment strategy. It is not timing the market or finding the right fund. It is $250 or extra dollars per month redirected before lifestyle absorbs it. In scenario 2, Marcus crosses $100,000, the boost threshold around when he turns 51. In scenario 3, he crosses it around 48. 3 extra years of Phase 2 compounding is the mechanism behind almost $200,000 of additional terminal wealth. Before the turbo kicks in, crossing the threshold even slightly earlier is worth dramatically more than it looks in the near term. Here are the 3 levels for getting there faster. Not generic advice, specific mechanisms with specific actions. Level 1 is contribution right-sizing. The most common reason people invest less than they should is institutional inertia, not inability. They set up automatic contributions when they opened the account and never updated them. Income has grown. Fixed expenses have shifted. Cost of living has changed. The autopay still says whatever figure they typed into an enrollment form years ago because updating it takes 15 minutes that never gets scheduled. The action is specific. Log in today and increase your monthly contribution by $50. Not a life-altering budget overhaul. One login, one change. Over 20 years at 8%, $50 extra dollars per month compounds to approximately $2,900 from one 15-minute decision. Then create a recurring calendar reminder for every January 1st to review and increase the figure again. You do not have to decide in advance how much to increase it. Reviewing it annually means you will catch the years when a raise came and went without being redirected. That is the entire system for Level 1. Level 2 is income growth redirection. Most people are on a slow but real upward trajectory in earnings across their careers. Raises happen, annual bonuses happen, tax refunds happen, side income happens, and in nearly every case within 90 days of receiving more income, the lifestyle has absorbed it, not through deliberate decisions. The money diffuses into slightly nicer habits, slightly more convenient services, slightly newer versions of things you already owned. The lifestyle ratchet clicks forward automatically. Nobody decided to spend more. It just happened. The rule that works, and this is the mechanism behind the portfolio outcomes I have seen in people I know personally, not theoretical investors, is to redirect 50% of every net income increase directly into investments before lifestyle calculates that it has new budget. Your lifestyle still improves on the other 50%. Your threshold timeline accelerates. Both things happen simultaneously with zero deprivation. The single critical variable is speed. The longer the gap between receiving new income and executing the investment decision, the lower the probability the investment decision actually gets made. Same-day automation eliminates the decision entirely. Your future self handed new money without prior instructions will spend it. Your current self making the decision in advance and automating it today will invest it. Level 3 is life event contribution resets. There are predictable financial moments in most adult lives where a significant recurring expense ends permanently. A car loan paid off, a student loan cleared, a child becoming financially independent, a mortgage refinanced at a meaningfully lower rate. Each of these moments creates a window of unallocated monthly cash flow that does not yet have a destination. The average American car payment in 2025 ran just over $700 per month, according to Experian data. When that loan ends, $700 per month is suddenly free. Most people do not consciously decide what happens next. Within 3 months, the lifestyle has quietly claimed it. It went towards subscriptions, dining, a slightly nicer version of something, and nowhere in particular. An intentional investor executes a contribution increase the day the final payment clears, not when they get around to it that specific day. Before the lifestyle knows the money is free, redirect $300 to $400 into investments. Let the remaining $300 to $400 improve daily comfort. Both things happen. The threshold moves forward. Nobody feels deprived. This is architecture, not willpower. You design the system so the correct financial decision executes automatically at the moment when behavioral friction is lowest. The decision your current self makes in the abstract is the one that actually runs. The decision your future self makes while holding newly freed cash flow almost never goes to investments. Here is what I have been building towards since the beginning of this video. I save this for here because it lands harder once you have seen the full picture. The years that matter most in a 30-year compounding journey are not the final 5. Even though those years produce the largest absolute dollar increases on your statement, the years that matter most are the first 5. A dollar invested in month 1 of your portfolio at 8% annually becomes approximately $10.60 after 30 years. That same dollar invested in year 25 of your portfolio compounds for 5 remaining years and becomes approximately $1.7. Your earliest dollars are worth more than 7 times your later dollars in raw compounding power, which means every month you invest below the threshold, every year you stall on increasing your contribution, every raise that your lifestyle absorbed before you redirected it. You are not losing small amounts of money. You are sacrificing the most expensive dollars in your entire portfolio. The ones with the longest runway, the ones that will compound for 30 years instead of 5.